A year ago, if someone had asked me the difference between saving and investing, I probably would have said they're basically the same thing. You put money away, you become more responsible, your future gets better, right? That's what I thought too. So I started saving money. Not a lot, maybe $100 one month, $200 another month, sometimes less. But for the first time in my life, money wasn't disappearing instantly. And honestly, that felt amazing. Every time I opened my banking app, seeing the number slowly grow made me feel like I was finally becoming financially responsible. Like I was finally getting my life together. And after a while, I hit my first big milestone, $10,000 saved. I remember staring at the screen thinking, okay, I'm finally doing this right. But then something strange happened. One night, I randomly checked how much interest my savings account was actually paying me. 0.5%. That's it. So I did the math. $10,000 sitting in my account for an entire year would make me about $50. $50. That was the moment something clicked. Because suddenly, saving didn't feel powerful anymore. It felt slow. And for the first time, I started asking a question most people eventually ask. Wait, am I supposed to be investing this? And that question changes everything. Because saving money and investing money are not the same thing. Saving protects money. Investing grows money. And understanding that difference is one of the biggest financial shifts a person can make. Now, before we go further, I need you to understand something important. Saving money is not bad. In fact, most people should save money first, because saving teaches something investing cannot: control, discipline, delayed gratification. If you cannot consistently save money, you probably won't consistently invest money either. So saving matters a lot. But saving alone has a hidden problem most people don't notice immediately. Your money isn't growing very fast. It's waiting. And waiting feels safe until time starts working against you. Let me show you something crazy. Imagine two people. Both start with $10,000. Person number one puts that money into a savings account, earning 1% yearly interest. After 1 year, they have about $10,100. Not terrible. But now, imagine person number two invests that same $10,000 into something averaging around 10% yearly growth. After 1 year, around $11,000. Now, at first, that difference doesn't look life-changing, which is why most people ignore it. But the real difference appears later, because money has a strange ability. Money can grow money. And once that starts happening consistently, everything changes. After 20 years, that same $10,000 in savings at 1% becomes around $12,000. But invested at 10%, over $67,000. Same starting money, completely different future. And this is where most people suddenly realize something important. The biggest financial gap in life usually isn't between people who spend and people who save. It's between people who save and people who invest. But here's the problem. Most people never make that transition. Not because they're lazy, not because they're stupid, because psychologically, saving feels safe. Investing feels dangerous. When your money sits in savings, nothing moves, nothing drops, nothing becomes unpredictable. But investing, prices move constantly. Some days you make money, some days you lose money. And emotionally, human beings hate uncertainty, especially when it involves money. That's why people stay stuck in saving mode for years, because stability feels comfortable. But here's the strange thing. What feels safe short-term can quietly become risky long-term, because inflation never stops moving. Every single year, life gets more expensive. Food, housing, transportation, education, everything. So if your money grows slower than inflation, your purchasing power slowly shrinks. Even if your account balance looks bigger, That's the scary part most people never notice. Doing nothing with money still costs money. And wealthy people understand this deeply. That's why they don't just save money, they invest it. Because money sitting still gets weaker. Money invested wisely gets stronger. Now here's where most beginners panic. The moment people hear investing, their brain immediately imagines stock market charts, day trading crypto, risk losing everything. And social media makes this worse, because online investing looks dramatic. Fast money, luxury lifestyles, huge gains overnight. But real investing usually looks boring, and that's actually a good sign, because sustainable wealth building is usually quiet, consistent investing, long-term thinking, patience, systems. That's what real investing looks like. And ironically, that's why most people avoid it, because it doesn't feel exciting enough. Now let's talk about the actual transition from saving to investing, because this is where people get overwhelmed. They think they need thousands of dollars, perfect timing, financial expertise. You don't. You need a process. Step 1. Build an emergency fund first. This is non-negotiable. Before investing heavily, you need financial stability. Usually around 3 to 6 months of living expenses saved in cash. This money is not for investing. It's protection money. Because emergencies happen. Job loss, medical bills, unexpected problems. And here's why this matters psychologically. People panic sell investments when life becomes unstable. An emergency fund protects you from emotional investing decisions. It protects your future investments from your current problems. That changes everything. Step 2. Separate your money mentally. This sounds simple, but it's powerful. Create 2 categories: safety money, growth money. Safety money stays stable. Growth money gets invested. That mental separation reduces fear dramatically, because now you stop expecting invested money to behave like savings. And that emotional shift matters a lot. Step 3. Start ridiculously small. This is where most people hesitate. What's the point of investing only $100? But this question misunderstands the goal. At first, investing is not about getting rich. It's about becoming someone who invests. That identity shift changes behavior permanently. And honestly, small amounts become big amounts much faster than people expect. Look at this. If someone invests just $300 every month for 25 years at around 8% yearly growth, they could end up with around $285,000. But here's the crazy part. They only personally contributed around $90,000. The rest? Growth, compounding, time. That's when people realize investing is less about effort and more about consistency plus time. And that's exactly why starting early matters so much. Because compound growth is strange. At first, it feels invisible. Then suddenly, it feels unstoppable. Most people quit before that moment arrives. Wealthy people don't. Step 4. Keep investing simple. This is another massive mistake beginners make. They think complexity equals intelligence. So they jump into day trading options, constant buying and selling. But historically, simple long-term investing has beaten most emotional, complicated strategies. That's why so many wealthy investors recommend index funds. Because instead of trying to predict winners, you simply own a small piece of hundreds of companies. Simple, diversified, long-term, and most importantly, emotionally sustainable. Because the biggest enemy in investing usually isn't the market, it's panic. People buy when emotions are high, sell when fear is high. And that emotional cycle destroys wealth, which is why systems matter more than motivation. Automatic investing, automatic transfers, automatic consistency. Because systems protect you when emotions try to sabotage you. Step 5. Think in decades. This changes everything. Most people think financially in weeks. Wealthy people think in decades. That psychological difference completely changes behavior. Because when you think short-term, market drops feel terrifying. But when you think long-term, market drops often look normal, even useful. Because experienced investors understand something most beginners don't. Lower prices can actually help long-term investors. Because consistent investing during downturns means buying more shares cheaper. That's why calm investors often win. Not because they predict everything perfectly, because they stay consistent emotionally. And honestly, that's one of the biggest hidden truths about wealth. Wealth is rarely built through intensity. It's built through consistency, over and over, quietly, patiently. Now here's the part nobody tells beginners. At first, investing feels underwhelming. Your portfolio barely moves. Growth feels tiny. Progress feels slow. But beneath the surface, something much bigger is happening. You're building discipline, patience, emotional control, long-term thinking. And those traits matter beyond money. Because wealth is not only a financial skill, it's a behavioral skill. That's why some people make good money for decades and still stay broke. Because income alone doesn't create wealth. Behavior does. And investing slowly transforms behavior. You stop thinking only about consumption and start thinking about ownership. You stop asking, "What can I buy today?" and start asking, "What can grow for years?" That's the mindset shift that changes lives. So, if you're currently saving money, that's good. Seriously, you're already ahead of most people. But understand this: saving money creates stability. Investing money creates momentum. And eventually, your money needs momentum. Because there's only so much freedom savings alone can create. At some point, your money must begin working harder than you do. And the beautiful thing is, you don't need perfect timing, huge money, or expert knowledge to begin. You just need small, consistent actions, simple investing habits, and enough patience to let time do what it does best: multiply consistency. Because turning saving into investing is really about turning fear into growth, stability into momentum, and income into long-term freedom. So the real question isn't, should you start investing? The real question is, how much longer are you willing to let your money sit still before it finally starts building your future?